Welcome back. You're watching the ET Money Show with me, Kavita Thapliyal. Now, a common way that investors diversify their portfolio is via investment in global markets. Now, this not only diversifies their investment but also helps them shield their money from excessive domestic fluctuations. But as the Indian market routinely outperform their global peers, does it still make sense to diversify investments globally? And if yes, then how should an investor go about international allocation in the year ahead? Let's discuss all of this with Tarun Birani, founder and CEO, TBNG Capital Advisers. Tarun, good evening and welcome to the show. All right, international diversification at this point in time where Indian equities look really strong and happening, and where there are headwinds in the global markets, you think it's the right time to initiate that aspect of diversification?
So good evening, Kavita. I think very interesting topic, and I feel uh, ideally we diversify to other geographies while allocating because the correlation with the other capital markets is low and would provide us a shield, right, in terms of a downside protection if your home market doesn't do well. And we have tried doing a correlation study of last 3 years with Indian market, with the Chinese market, and with the US market. And all these 3 year correlation studies very clearly demonstrating that there is a with India and China, there is a 0.25% correlation, and with India and US, there is a 0.37%. The 0.37, which clearly tells there is a good diversification benefit gets because both the markets behave very differently. Again, this is very important reason the markets are not. Second is the depreciation, right? Our currency has been depreciating for the long, right? So if anybody has plans outside India over long term, let's say looking at a kid's future education, or let's say any lifestyle expenses we are looking outside, from that point of view, again, mitigating currency risk could be again one of the reason for investing. And third could be getting access to high quality companies which are not available in your home market. So if I look at, there are many sectors where there are no companies available, high quality companies available in India. So if I look at defense, I look at technology, consumer technology, if I look at, there are not many names available in India. So from fear identifying such high quality company, I will look at diversification. Yes, I know last 1 to 1.5 years has not been a great period for global market, but this is where a detailed suitability in terms of understanding of the risk profile of the investor, financial goals, tax structure, all these need liquidity requirements, all these need to be studied before investing. So if you have very clear cut goals going forward, I feel 10 to 15% diversification outside your home country makes a lot of sense.
So now let's talk about on behalf of someone actually who wants to start doing this from now on. You said the US and China, these are two markets where we can actually look at diversifying our portfolio, and the allocation amount could be around 10 to 15%, and that one will do only when they are well diversified in their home portfolio, or maybe they have their core portfolio sorted. Only then they should just add a touch of international markets on their already lined up and gold aligned portfolio, I would say. Let's talk about diversifying into international markets to specific sectors. Now, let's say technical or tech sector. Do you think this really makes sense? Or, EV is quite a booming theme where we are seeing that even Indian AMCs have launched funds which cater to international markets and this particular theme. Can one really look at the innovation in their portfolio when it comes to diversifying internationally?
So I have a very different viewpoint here, Kavita. I think I am talking more from a fundamental point of view that diversification is very critical from home country market. It is not just because you don't have a EV available here, but from the bigger reason I feel is, let's say we are talking about technology. So we don't have such consumer technology names available in India. I understand EV is also one space, but there are some froth and glamour attached to a lot of investing outside also. So that is one very big reason we need to be very careful not to go by first build up a core portfolio. And I feel building a core portfolio, let's say S&P 500 in your portfolio and Nasdaq in your portfolio, or a good emerging market index fund in your portfolio, could be a good development of core. I feel most of the Indian investor doesn't have a good core portfolio, international portfolio available. So that could be a great start. Talking specifically about technology, we have seen last 2 years have been very different, right? I think 2021 behaved very differently, 22 behaved very differently. 22, with the start of almost 350 to 375 basis point rise in the interest rates, we have observed that most of the contraction is happening globally, and risk of environment has happened globally. And due to that, lot of money has come out of these high flying sectors like technology, and we have seen almost an index like Nasdaq also have corrected more than 30%. Going forward, my guess is that we are more or less at the peak of the interest rates globally also, and bearing first quarter some hikes, we will start seeing a pause in the interest rate hikes globally. So my sense is next 6 to 8 months are very interesting times for anybody who want to build up a staggered investment into, let's say, a Nasdaq index or a technology index, because that can actually help you build a good long term portfolio. But my sincere request is, first identify your goals. You should have a genuine requirement of these funds. If these funds are meant for liquidity in couple of years, 3 years, please don't invest that money. If they are aligned with that next 5 to 10 year thought process, I think these are great interesting times to build up these assets.
Tarun, what about the tax implications?
So from a tax point of view, they as a fund, if you invest in an Indian fund which feeds into global funds, it gets debt taxation. So anything which you hold more than 3 years, it gives you indexation benefit like any other debt mutual fund. And post indexation, a 20% tax need to be paid. But since the indexation benefits are quite good, so it end up reducing your tax liability by a lot.
Also, what's the current status of SEBI's limit that's on AMCs for international exposure?
So again, this is for everyone. It's a public domain data, and
Yeah.
we can see that the restrictions have been there for quite long, and it is expected to go away. But I think we are still, due to the environment we are living in right now, with the global risk building up, I think this has been delayed. So, but there are some funds available where since they have not reached the limit, so there one can invest into such funds
And
right
the
now.
passive route that you're talking about, it's the
That's
ET.
correct. That's
Okay.
correct. That's
Okay. And that's also the right way to get into international markets, especially if you're just starting off, if you're just a beginner.
Yes. Yes. Again, for beginners who don't understand investing also, my suggestion would be start with Indian markets. Don't go global so fast. First, start with Indian market, get your investing experience, at least for say 2, 3, 4 years, build up a good India portfolio. And after that, start building up some diversification in the portfolio through global route. Because what happens is, internationally, then investors start looking at a lot of data points, lot of news flows which they are not equipped to handle. So first part should be at least to start early, right? I don't want them to get into that wrong habit of observing a lot of data points and stop their investing. So first let them start, and then after 3, 4 years maybe they can start looking at global.
Tarun Birani, thank you so much for being on the show, and quite a detailed conversation we had on investing or diversifying internationally. Thank you so much for helping our viewers with that today. And on that note, let's take a quick break. Post that, let's do a live financial planning session with our financial planner on board today, Hemant Sustagi.